Oh, hello, and very warm welcome to StudyIQ. I am Prashant Mauni. I hope you all are doing good, dear friends. Today we have on our table RBI's bi-monthly policy. We are going to go through it. We are going to see how it works and things like that, and why it is important for not only your exam but for your economy as well, for the economy of our country. And this bi-monthly policy of February 2018, it is one of the most important one because it is coming out just after our union budget. And the other thing is that this is the last one of this financial year. In total, you have 6 bi-monthly policy in 1 year, as the name itself suggests that it is a bi-monthly policy. Now, the thing is, dear friends, you would be able to download this lecture from my Facebook page, as well as I would like to introduce all of you to our pen drive and tablet courses for various different exams. StudyIQ provides different pen drive and tablet courses. To find out more about it, all you have to do is check out studyiq.com. Now, dear friends, this is not the first time I'm discussing this bi-monthly policy with you guys, right? Back in December 2017, we discussed and analyzed this 5th bi-monthly policy. So what is going to be different in this discussion? Of course, we are going to use some fresh examples. And the thing is that every bi-monthly policy, right, RBI comes out with some reasons. It gives us or presents some reasons that if there are any changes, if they have made any changes, then why they have made these changes, and if they have not, then why they have not taken any stand, or why they have not in fact made any changes. So it is important every time. The basic stuff around it is going to be the same. And the reason why I'm explaining this thing is because I know many people out there, you'd be shaking your heads when I say that you are a regular follower of this channel. You go through important videos that are delivered to you on regular basis, but many of you would be new to this thing. For you, this could be the first bi-monthly policy review. So don't worry about it. I will use as simple examples and layman's language as possible so that everyone on board can understand what this thing is all about. So without wasting any further time, let's crack on. Now let's understand what is a monetary policy. Now the word monetary, once we understand what monetary is all about, then I think things will become a bit more easier. Monetary has its root in Latin word called moneta, and moneta stands for money. So basically, monetary policy is all about money. Now, when I say money, I'm sure one thing that pops up in your mind is RBI. RBI is the apex bank of our country. It is the top bank, and RBI is the one who comes out with this monetary policy. That is the reason why you have this title as well, RBI's monetary policy. So RBI is the bank that looks after this monetary policy, and the nature of this monetary policy is macroeconomic. That means whatever changes are applied on this monetary policy will have a sort of ripple effect or multiplier effect, or you can say it will impact the whole of our country. It will impact the whole economy of our country. It could be in good way, it could be in a bad way, but it impacts at macro level. It's not just going to have impact on micro level. So it's a big thing. That is the reason you find this word macro here. So it is a macroeconomic policy, and one of the reason why you come out with this monetary policy is or one of the main job of RBI, you can say, is money supply and ensuring or keeping an eye on this interest rate, making sure that money supply is at healthy level, as well as this interest rate too. Now, of course, I can understand you would be having many questions that why we need to supply money, why we need to look after this interest rate. In a minute, I will explain those things to you as well. But before that, let's see, let's go through some of the objectives of this monetary policy. Inflation, first of all, this is one of the main objective of macroeconomic policy. Now, inflation, if I break it down, what inflation is all about, basically inflation means a rise of price in all things that you buy in retail, like milk, your vegetables and fruits, your fish and meat, eggs, and other items that we consume on regular basis, right? There are other things as well, but for our understanding, these things are enough for now. So if there is a price rise in, say for example, tomatoes, then you cannot say that just rise or price rise in tomatoes, you cannot term it inflation. But if milk is going up, if your meat and eggs and rice and grains and all these things are going up, then you can of course say that inflation is taking place. Then you have this consumption, whether items or products and services, whether they are being consumed in the market, or you can say that if there is any demand of these items. So consumption is one more thing. This is part of this macroeconomic policy, and to keep an eye on it and to ensure that everything is going at healthy level. Now you will be also having a question like what healthy level is all about. In a bit, again, I will explain all these things to you. Then you have this growth. Of course, very simple to understand, that whether our economy or the country is heading towards or are we in a path of growth, and this path we can have a growth of radical in nature. That means graph going up or shooting up in the sky, or you can have this incremental graph, just something like this one going up, isn't it? Or the growth could be falling down as well. Again, it could be you can say heading straight down, or it could be coming down gradually. So it all depends. So this is number 3 or C, and the D is liquidity, money, right? Whether money is easily available or not. If it is available, then what is the interest rate at which it is available? If it is not available, that means there is something going wrong. And one more thing, when I say liquidity, we have to keep this thing in mind, that it should not be in too much liquid state, right? It's a little bit of liquidity is fine, and you can compare this thing with your blood. Money is like a lifeblood for businesses or for economy. So if your blood flow is too much, then as well it is not good. If your blood flow is too slow, then as well it is not good. So something similar, you can apply it on money too. Now many questions so far, like why we need to supply this, why we need to keep a tab, or why we have to monitor this money supply, why we have to look after interest rates and things like that. Very simple. One formula that is working, or one theory that is working behind all these things, most of the things that are going on in any economy, is demand and supply. So whenever you have any sort of demand, then there would be many players in the market. They will supply that demand. Now let me give you one practical example from your own life. Just imagine that you are doing a job, you are working somewhere, and every month you earn 10,000 rupees. Now, as this is a hypothetical example, an imaginary example, so let's say that you have a motorcycle, you have a mobile phone, and you are young. At the same time, you are not living with your parents, you are living in different city, and you have to pay your rent as well and things like that. Then you have to travel up and down every day using your motorcycle. So you can imagine that there are many things that basically these things are taking away your money, isn't it? You would be paying your rent, you would be paying your motorcycle maintenance and petrol and diesel and whatever other things, mobile recharge, and then once a month or once every fortnight you go out to eat or for cinema or something. So you can understand in today's era it would be nearly, if not impossible, it would be a bit difficult for you to manage everything in this 10,000 rupees, isn't it? So what will happen is that the choice of your restaurant would be, of course, not a high-end one if you are earning 10,000 rupees per month. So you would be choosing those sort of restaurants. This will have an impact on your clothes as well, on the things that you spend money and other things, right? Because at the end of the day, you would be doing a little bit of saving as well. Maybe it may be 500 rupees or 1,000, it doesn't matter, but you'd be inclined to do. So we are taking a sort of an ideal or an average example here. So here the thing is that the supply of money is limited and you value every 100 rupees that you have in your pocket. The second scenario could be that all of a sudden you come to know that your company is very happy with you and they have decided to elevate you, and from now on your salary is 50,000 rupees per month. So the money supply has gone up. Now you will find that you will think about buying a new motorcycle or new mobile phone, or maybe new clothes or new shoes or other things. Now your choice of your restaurant will change as well. you'll buy perfumes and many other items, right? And your saving will go up as well. So you can see that as soon as this supply of money got increased, your demands started going up as well, isn't it? First you were managing everything in 10,000, but now you realize that 25, 26 or 30,000 as well is something that you feel is not enough for supporting your lifestyle. So what we can learn from this thing is that when the supply of money goes up, right, when you are provided with you can say extra money, then that value of that money will come down as well, right? For earlier on 100 rupees was a big amount for you, but now when you are making 50,000 per month, for you 100 rupees is something equivalent to, say for example, 500 rupees. So the value of money has gone down. Same thing applies in a market as well, or in any economy, and this is the reason why we are discussing this money supply and interest rate. So what happens is that if too much money is flowing in the market, if people are having extra supply of money, then what will happen is, first of all, the value of money will come down. They will not value the money that they have that much. The other thing is that you have limited amount of, now forget about the money, now let's talk about products. Say for example food items, say for example milk. Now you can produce, means of course the things can go up and down, but just for an example, let's imagine that you can produce only 10 liter of milk throughout the country, and you have 100 a population of 100 in a country, and now 10 liters, so the supply is limited. But now for you the money is not a matter of concern, so you will pay extra money, and the person who is selling it will realize this thing as well, that if people are having money in their pocket, then it is better to increase the price of milk, isn't it? So limited supply of milk, many people are looking for milk, so they will pay that extra money, and this way the price will go up. Now this thing applies to other products as well. So I hope this thing is clear. We are talking about two, demand and supply here. One is about money, flow of money going up, and demand, or you can say the value of money coming down. So this is one thing, and the other thing is related with products and services. So when you have limited amount of food grains, tomatoes and other things in a season, and when you have people with money, so they would be chasing after these products, and this will kick up the price. So I hope these things are clear to you so far. If they are not clear for you, for all those beginners, I would reckon all of you to restart this video again and go through the things that we have discussed so far, because this is a very important concept of demand and supply, and this is not just limited to your monetary policy. You can apply these things in everything, right? Most of the things in our life, you can apply it with your competitive exams. You have limited seats every year, 1,000 maybe. UPSC wants to fill this 1,000 seats, and then you have lakhs and lakhs of students. So this is the reason, right, that the supply of seat is limited, and this is the reason why the demand goes up. When you have, say for example, 1 lakh jobs available, and if you have 2,000 students applying for it, then you can understand that there is no demand of this thing. So this is how it works, and you can apply it in other things as well, as I told you. So now let's move on, and let's see how this thing is implemented. What are the tools in the hands of this RBI through which it can control this interest rate and the money supply? Now, as you can see on your screen, there are many things. You have open market operations, you have bank rate policy. This is the thing on which we are going to have a detailed discussion. Bank rate policy. Then you have this reserve system, credit control policy, moral persuasion, and through many other instruments. So all these things, right, are tools that I told you about, through which RBI can control this flow of money. And as I told you that we are going to talk about this repo rate and reverse repo rate. So let's quickly go through and let's understand that what this repo rate and reverse repo rate is all about. Now, repo rate. RBI, as you know, RBI is the apex bank, and imagine that SBI requires some sort of money from the bank. Then of course RBI will not give it for free. SBI will have to provide some security, and RBI will give the money, and this money will be charged, right? This is a loan, just like any other loan that we take from any other bank. So SBI will take loan from RBI, and RBI will charge a particular interest rate on this loan, and this is what it is called a repo rate, right? This is repo rate. At present, the RBI has decided to keep it at 6%, right? So the repo rate is at 6%. So basically, the amount of interest charged by, or you can say the interest rate that SBI will have to pay, or any other lower banks have to pay to RBI when they borrow money from RBI. So this is repo rate, and the reverse one is when RBI borrows loan or money from SBI. So again, SBI will charge this sort of interest rate, and this is called reverse repo rate. I hope these two things are clear now. Why do we need this repo rate and reverse repo rate? Why this RBI is borrowing money from SBI? Because to control money, if there is too much money flowing in the market, then what RBI will do is RBI will increase interest rate, right? RBI will increase this interest rate. So what will happen earlier on? Let's imagine that interest rate was 1%, and there was too much money out there in the market. But now RBI decides that let's make it 10%. So what will happen is that RBI, then you have this other banks, right? And you have these banks here, and then you have this market here. So cash, people will think that earlier on, when you used to keep your money in your bank, you would get 1%, but now RBI is paying 10%. So it's better, rather than investing it somewhere, it is better to deposit our money in our bank account, isn't it? And the bank will give them somewhere around 10%. This is just an imaginary example, right? So don't pay too much attention on this 10% rates. Many times this rates may sound illogical, but it is just for your understanding. I hope you understand what I'm trying to say here. So when this money will be parked in the bank, these people will start in the market, or customer, they will start making money out of it, right? Depositor will get some sort of interest, or he will make some extra money out of it. And imagine when everyone starts depositing their money in the banks. So basically what happens is that when interest rates are going up at that point of time, money will come back to the bank. So in this way, in the market, you will find less money in the market. At the same time, what will happen is if you are borrower, right, then for you it is going to be very painful, because you now have to pay extra amount as your interest, isn't it? So it is going to be difficult for you. This is something that borrowers will not appreciate, but depositors, they would be more than happy when interest rates go up. So I hope this thing is clear, and this is how you control the money. When interest rates are lowered, same thing, the reverse thing happens. People will people will borrow more money from the bank, and this is how you can say this tap of money will be opened by this bank. So money will flow in the market. So this is how it works, right? Reverse repo rate and repo rate. I hope this thing is clear as well. And then you have this reserve system. You can go through this theories, but I'll give you one more example of this reserve system. And reserve system, when you open a bank, RBI will ask you, say for example, RBI will say you that if you are SBI, if you are new in the business, then you will have to keep, out of 100 rupees that you have to give out, you have to keep 20 rupees with RBI, 20% you have to keep it here. And then you can use this 80% that you have now, and now you can give this 80% as 80 rupees that you have as loan, or 80%. Anyways, now if RBI wants to increase the flow, what it will do is it will say that you can take your 10 back from this 20, and we will keep this 10, and now you can have your 90, and then you can give this money out. And if it wants to control it, then it will say that rather than 20, you have to park now 50 rupees with us, and you can use the rest 50 that you have. So of course the money will become a bit expensive, because now SBI will have limited amount of money. Most of its money is blocked with RBI. So this is how this reserve system works. Then you have some other technical things like whether you will get interest or not. This sort of things I will leave it on you guys. I'm sure you will go through your NCERTs and they're easy to understand as well. Once you know why these things are necessary. Once this thing is clear, most of the things with your economy will be a cakewalk as far as I know, right? This is very important. This demand and supply particularly is a very important concept. So here you have two things, right? Two types of monetary policy. They can be expansionary and contractionary. Expansionary, basically you can understand money flow going up, and contractionary, basically money flow being made a bit tightened, isn't it? So difficult to get money or the flow is controlled. Now, who decides this whole things, whether we should increase the flow or decrease the flow? Earlier on, what used to happen is that RBI used to take all the decisions pertaining to this thing, interest rate going up and interest rate going down. And the situation was situation of RBI was a bit tricky as well, because you have a contradiction in the market. You have this demands from different groups, and most of the times the demands are in contradiction with each other. Now let me give you an example. As a consumer, we would love to pay as less as possible for petrol. If it is 10 rupees, then we would be more than happy, isn't it? But at the same time, right, imagine if you are a pensioner, you would require more money coming to you every month. So you would be asking for more inflation so that your pension can be adjusted based on your inflation, and you would get some extra money. As a consumer, you would require, or you would prefer inflation coming down, or if inflation is at healthy level, so that the items that you purchase are cheaper. Then you have this businesses, right? They lobby RBI and they lobby government, and they want loans at cheaper rate. At the same time, you have government requires, or government would wish for higher growth rate. At the same time, government wants to keep this inflation under control as well. So it was a bit tricky situation for RBI. So finally RBI decided, means these things were affecting the performance of RBI as well, because it has to take, earlier on it used to take many things into account, like account inflation, growth, employment, banking stability, and the need for stable exchange rate, and many things. So later on it was decided that an expert committee should be set up, and under Urjit Patel at that point of time, he headed this committee. He was the chairman of this expert committee. At present, Urjit Patel is the governor of RBI. So back in 2014, this committee came out with its recommendation, and one of the most important one was that rather than taking this multiple indicators into account, this one's right, it is better to just focus, or this RBI should just focus on inflation, right? It should target just the inflation. Of course, the main objective is to ensure that everything is in line with the economic agenda of the government. So it should support growth, it should create employment and everything, but inflation is the only thing that RBI will look after as far as this monetary policy is concerned. So it was decided. And the second and one of the most important bit here is it also recommended constituting this monetary policy committee, MPC. You have 6 members at present in this MPC. 3 members are from RBI. They are going to be there, means you have this chairperson of this MPC is RBI governor. At present it is Urjit Patel. Then you have deputy governor as a member, and then you have one officer from RBI, and then you have 3 members. They are recommended by the government. So you have a balance of, or you can say that 2 is better than 1. So in this way you have many heads working together and taking a sort of democratic decision, if I can say that, because how it works is that majority wins, and just in case if you have a tie, then it is the final say of RBI governor that will matter. So if you have this tie situation, 3 members saying RBI that rate should go up, 3 members saying that rate should go down, then you have this final say of RBI governor. If he says that it should go up, then it will go up. If he says that it will go down, then it will go down. Simple as that. So this is how this monetary policy committee works, and this is the background of its inception and things like that. Now quickly, Sixth bi-monthly policy, as I told you, it's out. Now you know the rate. The lending rate or the repo rate, right, is at 6%. The reverse repo rate, hold on a second, reverse repo rate is at 5.75%. And in last discussion on this bi-monthly policy back in December, right, at that point of time as well, we discussed this thing that we talked about this repo rate and reverse repo rate, and as you can see the figures are same. So that means that in sixth bi-monthly policy, RBI has not made any sort of changes as far as this repo rate and reverse repo rates are concerned. The second thing I would like to mention here is that it was only in August 2017 when this lending rate or this repo rate was slashed by 0.25%. Apart from that, we haven't seen any sort of cut from ages, and the stance that is, or stance basically means your posture, how you are taking this whole thing that is going on in economy. When I say you, I mean to say this Monetary Policy Committee, or RBI in short. They have adopted this neutral stance. Neutral stance means that you are at a neutral state. You know, your cars, you have you can either go ahead if you use your gears, or you can have your reverse gear. So in the same way, right, this neutral stance is something similar. At present you are here, this RBI or monetary policy has kept everything at a neutral state. So it will depend, it depends, right, whether it will depend on this MPC, whether they want to increase the interest rate or they want to bring it down. This is what neutral stance is, means this is basically neutral stance. And then you have accommodative stance as well. In accommodative stance, what you do is basically you keep a close eye on things that are going on, right? You keep your eyes and ear open. You're a bit skeptical, and you will keep your eyes and ear open, and you will closely watch the movement of money or interest rate, and if required you will take a very quick decision. But neutral stance is also an indication that for time being, right, nothing is going to change. Things are going to be at neutral state. So this is the stance that is that we can see, or the posture of MPC at present on this monetary policy. Objective, as we talked about, this inflation, right, this inflation targeting is the main job or the main thing that RBI has to keep it, RBI or this MPC has to keep in mind. And the target that is given by the government to this RBI or MPC is 4%. You have a bracket of +2 or -%. So the lowest inflation can go is 2%, and the highest it can go is 6%. Now the matter of worry is that at present, as we are speaking now, 5.21%, right, December inflation rate was 5.21%. So you can see that we are very close to this, not that far from this 6%, right, plus and -2%. You have a window here. So if it is going above 6%, then it is going to be dangerous, no doubt. So we are here at 5.21. So this is the thing that now it is not a time that you increase the flow of money, because if you increase the flow of money, then you know now that things will become more expensive, because much money, or you can say a huge amount of money, chasing limited amount of goods and services are there in the market. So this is the thing, and as I told you that this is the first one, this first bi-monthly policy after this budget 2018, and the way global turmoil is going on at present. When I say global turmoil, I mean to say global financial markets, right? Federal Bank, this is very good example here for you guys. Federal Bank, or you can say RBI of USA, right, it has decided to increase bank rate. So it is going to pay you extra. You will make some extra money if you park your money in the bank. So naturally, all those investors of USA who have invested in Indian markets, now the money will flow. They will take or this money that they have invested in Indian market, and then they will park this money in the banks, because they would be earning more interest or easy money if they park their money there. So interest rate going up is creating a global turmoil. And if we go through inflation, then RBI has said that by the end of this year, this financial year, by the March end, CPI or Consumer Price Index is going to be somewhere around 5.1 to 5.6. So this is a matter of worry for RBI. So this is one of the reasons why they have decided to keep the rates as it is. The other thing is that you have many different things going on in the world and in India as well. You have this housing rent allowance going up, or government has decided to increase this housing rent allowance. Again, you have limited houses, but now you will have extra money in your pocket if you are government employee, and we have lakhs and lakhs of government employees around us throughout the country. So what will happen is that rent prices will go up because now you have extra money. The rents will go up, so this will increase your inflation. The other thing is that crude prices, very easy to understand. If fuel prices are going up, then your transportation will go up, transportation cost will go up, and all your goods basically, right, vegetables and fruits and other items that you transport on regular basis, they will become a bit expensive. Then you have this minimum support price decision taken by the government, that at least 50% extra will be provided on your cost of production. So 150 that you are going to get back. If you are invested 100 for, say for example, 1 kilo of rice, then at least you will get 150. So 50% is going to be your profit. So naturally the price of food items will go up after the implementation of this thing. And you have global growth as well, as we talked about. So global growth, I haven't said to you about this thing. Global growth, or the global economy, is doing well at present. And as you can understand, if global growth is there, then more goods will be produced and more goods will be transported from one country to another country, or domestic trade will go up, and then you will require more fuel. If you require more fuel, again demand and supply kicks in here. You have limited supply of fuel, but the demand is going up, so the price of fuel will go up. And a country like India, we import nearly 80% of fuel, so for us it is going to be, again, it is going to kick inflation. So these are some of the reasons, as you can understand now, that has in fact means taken into consideration by this MPC. These are the reasons that are going on around us. So these are the things that are going on, because of which interest rate we have not reduced or increased or kept things as it is. We are waiting, or MPC is waiting and watching at present. Then you have this GVA. GVA stands for gross value added, right? Is the measure of value of goods and services produced in an area, industry or sector of an economy. GVA is a key input of GDP that strips out taxes and subsidies. It was projected at 6.7% by RBI, but now it is 6.6. But next year, 2018-19, is going to be a bit okay for us because GVA growth is going to clock 7.2% as per RBI, and this other things that are going to be in favor of our economy is that GST implementation is stabilizing, so more revenue for the government, things more easy to do business, or ease of doing business will go up. Businessmen would be able to carry on their business activities a bit more smoothly. The second thing is that revival in investment activity, right? Credit takeoffs are taking place because of your IBC and recapitalization. So money is coming into the banks by money provided by government, and because this money will be distributed as fresh loans, and this will start or give motion to this cycle of economy, and people will invest, and if money is available, then they will invest it and open new business, or they will restart their projects and things like that. So jobs and everything. And so basically, again, it will add a pace into this wheel of our economy. It will give a bit of extra motion. Then you have this IBC, we have talked about it, and then export growth is also expected to improve. As I told you, global demand is there, global growth is going up. So these are the things that are going to be good in near future or forthcoming future. But so far that's everything that is important to this monetary policy. I hope things are clear to you now, and do check studyiq.com for our pen type and tablet courses. Dear friends, I will share this file on our Telegram channel as well as my Facebook page. You can follow me, and make sure you do share, share this lecture with other people as well. You can use your social media and your platform, WhatsApp and Telegram and other things, and you can share it with other people so that they can also benefit out of it. Don't forget to subscribe, hit the like button. If you have learned something, then please do give us your like. It motivates us, and pass your valuable comments. I will see you all soon. Thank you for listening me. Jai Hind.